Well, first, as an underlying company, I like that they're making money. For the last three, well, they broke even over here. Over here, they actually had a little bit of a loss. But I like that they, in the last couple of quarters, have shown some positive earnings. That's a good thing. That means that they've recalibrated their business, and they're making it so that cash flow is king. And cash flow right now, as I've been harping on this whole show, is king for a company. I also see that prices coming down here, Tanner, and testing this level of support. And as we just said on GM, we like to buy low so that we can then sell high. And so I see a signal that has formed. I'm going to zoom in a little bit to where we are right now. Let's go look at a 3-month chart. I see that on Tuesday, we were given a signal that possibly hinted at a bottom being found. But I have the same problem that I have with GM. And that is, I'm going to keep harping on this. I want to see some good volume. I want to see actual traders behind that price action going up. And I can even see it right here. I got that signal on Tuesday, and without the traders behind it, look at what happened yesterday. Price just fell right back down. Like I said, if you don't have volume validation, the price action can quickly be reversed. So I want to see a bottom signal forming on some tested volume, which means volume is heavier than yesterday, volume is heavier than the 50-day average, and volume has been building up over the last at least 3 days. If I see that, man, I'd get into this. I'd buy some of this, either the stock, and I'd buy it in lots of 100, because that's how options work. Option contracts are 100 option shares, and that has to match the stock shares. So I'd either buy 100 shares or a grouping of 100 shares of this stock. Or let's look at the health of the option chain. If I come over here and take a look at the option chain, okay. So they're trading every $2.50 up to the $25 mark. And then they go to every $5. That's a traditional option strike price, um, um, splitting up. And so that's great. The liquidity is a little bit questionable when I start to go for option substitutes. So what that tells me is you got to be in it to buy the stock. I wouldn't buy an option substitute. But at the same time, I do see some activity in the near term options, so we can sell premium against that stock. So I'd be into that idea. I'd be into buying some of this stock. That is when I get my signal. And then as price goes up, I would sell some call options. And so what that means is when I sell my call options, I'm locking in a sell price. So say, for instance, I buy this thing at $16 in the next couple of days, and then it goes up to, say, $20. I'll sell the $20 call to somebody, and they'll give me a premium. And what that says is, it says, I am going to be guaranteed to sell my stock to that person for $20. And either way, whether they buy it for $20 or not, I get to keep that premium. And that premium could be up as much as 10% every month. And so what would happen? Well, either I'd keep the premium and I'd do it again next month, basically keep renting out this stock, or check it out. If it does sell, I just made $4 per share plus all the premiums I've kept. So that's kind of the theory behind this, is that every time I sell a call option, I'm guaranteeing or locking in the sell price for this stock.
Yeah, I had to look into that article, and it's true. All drive-throughs are going to go cashless, and customers must pay with a credit or debit card. I don't know. I don't know if that's good for business.
I mean,
It,
how many people pay with cash these days anyway?